Moved, not slowly, not cautiously. It moved fast on Kevin Warsh's latest remarks. And if you were not watching the data closely, you probably missed what actually just happened underneath the headline. That is exactly what we are going to break down today, because his message is not what financial media is telling you it is. Stay with me. Let me start with what Warsh actually said, because the details matter more than the soundbite ever will. He came out this week with a very specific message to the Fed. He said the central bank is moving too slowly on balance sheet normalization. Not just too slowly on rate policy, but on the actual size of the Fed's balance sheet. That statement landed like a bomb in markets that had been pricing in a particular narrative. The narrative was that the Fed has pivot, that cuts are coming, that financial conditions are going to loosen. Warsh just questioned whether that narrative is actually correct, and traders who understood the deeper implication of his words started repositioning. That is what happened underneath the price action you probably saw. Now here is why his timing is so important. We are sitting in a moment where the Fed is sending mixed signals. The Fed has cut rates multiple times already this year. That sounds accommodative. But the Fed is also running quantitative tightening, letting assets roll off the balance sheet. That sounds restrictive. The Fed is saying it is data dependent, which sounds flexible. But the market has already priced in one interpretation of what data dependent means. And Warsh just introduced doubt about whether that interpretation is correct. When someone with his credibility and his history introduces doubt about what the Fed is actually going to do, markets respond. Let me walk through what happened in the markets in the immediate aftermath of his comments. Treasury yields moved higher almost immediately. Specifically, longer-dated yields spiked. The 10-year yield moved up noticeably in a matter of hours. Why? Because bond traders instantly started repricing the probability of future rate cuts. If Warsh's view has influence inside the Fed, and he is saying rates should not fall as much as the market expects, then longer-dated bonds are worth less. Yields have to rise to compensate. That is pure mathematics. The bond market does not wait for confirmation. It prices in probability instantly. Equity markets reacted too. Technology stocks, which are the most sensitive to changes in interest rate expectations, pulled back. Growth stocks sold off. Why? Because lower interest rates are a tailwind for assets that do not generate cash flow today, but might generate cash flow far in the future. When rate expectations rise, that tailwind disappears. The present value of those future cash flows shrinks. So the stock market sold off on the idea that Warsh's view might represent the actual Fed position going forward. Now, it was not a crash. The market did not collapse, but the direction was clear. The repricing was real. The dollar strengthened. This is the part that most retail investors miss completely. When interest rate expectations rise in the United States, international investors start thinking about the returns on dollar-denominated assets. Higher returns mean higher demand for dollars, so the dollar rallies. That has massive implications for international trade, for emerging markets, for the earnings of American companies that do business overseas. But it starts with the Fed signal and a change in rate expectations. Warsh's comments triggered that chain reaction. Commodities sold off. This too is connected to the Fed rate picture. When rates are expected to go higher, commodity prices typically come under pressure because the opportunity cost of holding non-yielding assets goes up. If you can earn 5% in Treasury bonds, you are less interested in holding gold or oil. Those commodities sold off on Warsh's message. Again, this is all connected. One comment from one Fed governor triggers a cascade of repricing across asset classes. Now here is the part where most people get confused about what this actually means for the economy and for investors. Warsh is not saying the Fed is going to tighten dramatically. He is not saying there is a new era of super high interest rates coming. What he is saying is that the Fed needs to be more thoughtful and more transparent about how monetary policy actually works. He is saying that rate cuts without balance sheet shrinkage can feel accommodative, while actually being less accommodative than the market believes. He is saying that fiscal policy is already running hot, the government is already spending at massive levels, and adding monetary accommodation on top of that creates an imbalance that has to be corrected at some point. Whether that correction comes through higher inflation or higher rates, or a combination of both, remains to be seen. But the correction will come. Markets are starting to price that in. Let me explain why his specific focus on balance sheet normalization is actually the most important part of his message, because this is where the real power lives. The Fed's balance sheet is a tool. It affects the money supply. It affects financial conditions. It affects asset prices. When the Fed has a large balance sheet and is reinvesting the proceeds of maturing securities, it is adding liquidity to the system. That is accommodative. When the Fed is letting securities roll off without reinvesting, it is draining liquidity. That is restrictive. But here is the crucial part that most people do not understand. The pace matters enormously. If the Fed is shrinking the balance sheet very slowly while also cutting rates, you can have a scenario where rates are falling but financial conditions are actually tightening because the balance sheet is shrinking. That is what Warsh is pointing to. He is saying the Fed is not shrinking fast enough. He is saying that if the Fed wants to actually normalize policy, it needs to be more aggressive on the balance sheet side. The market's reaction tells you that traders took him seriously. They did not dismiss him as a dove or a hawk making noise. They treated him as someone who understands the Fed's internal thinking and is making a legitimate case about what actually needs to happen. That case is, the balance sheet needs to shrink faster, rate cuts should be on pause, and financial conditions need to stay tighter than the market currently expects. If you build a positioning around that expectation, you sell bonds, you sell growth stocks, you buy the dollar, you sell commodities. That is what happened. Now, there are real uncertainties in how this plays out that deserve acknowledgement. First, Powell's response matters enormously. Powell is the Fed chair. His view is the view that actually determines policy. Warsh can make the intellectual argument all he wants, but if Powell does not agree, policy will follow Powell's framework, not Warsh's. The market is watching to see if Powell validates or contradicts Warsh's analysis. Second, the labor market could surprise to the downside. If unemployment spikes suddenly, the Fed will cut rates regardless of what Warsh thinks about the balance sheet. Employment is half of the dual mandate. If it is threatened, rate cuts come. Third, financial stress could emerge unexpectedly. A banking crisis, a credit event, something that tightens financial conditions involuntarily. If that happens, the Fed will prioritize stability over balance sheet normalization. Fourth, political pressure on the Fed could shift. The Fed is supposed to be independent, but election cycles, fiscal policy debates, all of that affects the political environment in which the Fed operates. Fifth, global economic growth could surprise to the downside. If the world economy starts contracting, that changes the Fed calculus entirely. So Warsh is making an argument about structure and normalcy, but the world is full of shocks that can override any structural argument. That uncertainty is real and it matters. But here's what I think is actually happening based on the data and the market reaction. I think Warsh has articulated something that traders and market participants were already sensing. There is a gap between the narrative the Fed is telling the market and the structural reality underneath that narrative. The Fed is saying it is normalizing, but it is normalizing slowly, cautiously, with a lot of deference to the idea that financial conditions should not tighten too much. Warsh is calling out that contradiction. He is saying the Fed needs to choose. Either it is normalizing, in which case it should do it more aggressively, or it is still accommodative, in which case it should stop pretending otherwise. The market's response tells you that this articulation landed. Traders started to reprice based on the idea that actual Fed policy might be more hawkish than the communication had suggested. Here is what I would be watching if I were trying to understand how this plays out over the next few weeks. 1. Watch Powell's next public communication. Does he validate Warsh? Does he distance himself? Does he clarify what the Fed actually intends? Powell's response tells you whether Warsh is speaking for the institution or just for himself. 2. Track the balance sheet data weekly. If QT accelerates, Warsh's argument is winning inside the Fed. If it stays flat, he is just talking. 3. Monitor financial conditions. The Chicago Fed's Financial Conditions Index is a good real-time gauge. If conditions are tightening, Warsh's message is working. If conditions are loosening, the market is fighting the idea. 4. Watch Treasury yield curve. A steeper curve would suggest the market is pricing in higher long-term rates, and a Fed that is less accommodative than currently expected. 5. Track equity market volatility. Volatility tends to rise when there is uncertainty about the Fed's next move. If volatility stays elevated, it means the market has not fully priced in the new framework yet. What this situation tells us about the broader structure of the market right now is actually quite important. The Fed has enormous power, but that power works through expectations and communication as much as through actual policy moves. When the Fed can control expectations, it can move the market with a whisper. When expectations get ahead of reality, or when different Fed officials send different signals, the market gets confused and volatility rises. We are in a moment where Warsh just introduced a very different signal into that environment. The market is repricing. That repricing is not complete. It is ongoing. And the direction of repricing tells you that traders are starting to believe that the Fed's actual stance is more hawkish than the market had been pricing. Is Warsh going to be right? I do not know. Markets are complex. They can stay irrational for a very long time. The Fed has tools to manage expectations. Policy surprises happen, but one thing I am confident about, the market is now paying attention to the balance sheet in a way it was not before. Warsh made that impossible to ignore, and that attention will shape how traders position over the next several months. Whether the Fed actually accelerates QT or not, the conversation has shifted, and conversations shape markets almost as much as actual policy does. This is the kind of Fed signal that creates opportunity and risk simultaneously. If you are positioned for continued accommodation and easy money, Warsh's message is a warning. If you are positioned for eventual tightening and higher rates, his message is validation. The key is understanding what he actually said, not just reacting to the headline. He is making an intellectual argument about the structure of policy. Whether that argument carries the day inside the Fed remains an open question. But the fact that he is making it and the market is listening tells you something important about where this environment could be heading. I would be watching this situation very closely over the next few weeks. The market's repricing is the first stage. The Fed's response is the second. If those two things align, the repricing sticks and becomes the new baseline. If they diverge, volatility rises as the market tries to figure out what the actual policy framework is. Either way, this moment matters. Warsh just introduced a new variable into the equation. The market is processing it, and investors who understand the implications will be positioned better than those who simply react to the surface noise. That is all I have for today. If you found this analysis valuable, subscribe to the channel. We break down these Fed communications regularly, and we focus on what they actually mean beneath the headlines. Drop a comment and tell me how you are interpreting Warsh's message. Are you seeing the same repricing in the markets that I am seeing? Hit the notification bell so you do not miss the next update. The Fed is one of the most important forces shaping markets right now. Understanding its actual position versus its stated position is critical. Keep watching, keep learning. Thank you for watching.